I'm here to talk to you about taxes and incentives. Just like you're on a journey, nations are also on their own journey, their own trajectory. And for them to do well, they talk about growth and development. Growth in terms of increasing their gross domestic product on an annual basis, development in terms of the environment, socio-economic sustainability. And for us to achieve that, one of the key area is revenue. If you don't have revenue, there's no way you can run a successful system. But there are tax havens. There are countries that are called tax havens. And they leverage on incentives and they also develop, which means that you can use incentive to also grow the economy. So I'm going to talk to you about the reality of revenue generation and the reality of tax incentives. How do they work? Do they work together? Every tax system has three pillars. We talk about the tax policy that drives everything we do. We talk about, which is always at the purview under the ministries, either Ministry of Finance or other relevant ministries that work together to drive policy. We also have the tax legislation, that's the laws that drives whatever, key into the policies that are in place. Then we have the administrators in terms of those who administer the taxes, whether it is the Federal Inland Revenue Service, whether it's the State Internal Revenue Service, whether it's the Local Government Revenue Authority, or whether it's the Customs. We're all working together to have that workable national tax system. So I'm talking about taxes, incentives, reason why we have incentives, policy consideration for tax incentives, the legal basis for tax incentives, the forms, and what is the need for you. And what is the need for you? When I get to the type of taxes, we'll be able to talk about the personal income tax and some of the reliefs and allowances that are available. Basic economics talks about growth and development. And I've informed you that development is what we require. And how to get to development is the fact that we need revenue. Now, revenue will increase if we expand the tax base. But perhaps if you use incentives, the incentives will sit on the tax base, which means the incentives will reduce or erode the tax base. So how do we do this delicate mix? That will use revenue to grow the system, and we also use incentive to also develop the system. There's never enough revenue in any setting. Never enough revenue. So aside from the revenue, which anytime you talk revenue, you talk taxes. So apart from the revenue, we'll be looking at what are the alternatives. The first alternative will be borrowing. If the government wants to finance its infrastructure and the revenue is not sufficient, they have to leverage on borrowing. But borrowing has its own burden. Borrowing has, for us on this part of the world, borrowing has always been a chunk on our neck, a big burden on our neck. And from the UNCTAD report, in 2010, it was 35% global to GDP. But as at 2021, it has grown to 60% that's globally, 60% tax burden to GDP. That is what we face as the world. Meanwhile, the global debt as at 2023 stands at 97 trillion USD. And everybody will say, yes, US has chunk, China has chunk, but we are the ones that are more burdened. So we've realized that borrowing has never been a sustainable way to fund the system. But outside the borrowing, outside the revenue, then comes the incentives. And that means that we can also use incentive to achieve development. Just that the result that you will get from incentive in the short run will be a takeaway from the revenue that's available. But in the long run, you can achieve development, growth and development using both the taxes and the tax incentives. So what are these taxes? Basically, it is the government that collects it. And there are different types of taxes. The direct and indirect, you all know. For companies that operate in Nigeria, there are so many incentives under the Companies Income Tax Act, so many. Then there's the personal income tax, which affects you and me. There are release, allowances, and rewards under the personal income tax. There's also the petroleum profit tax, where, incentives are so much because of the volume, the chunk of value of money that goes into operating in that sector. Then there's the capital gain tax legislation, exemptions from CGT. We have a list of exempted items from under the capital gain tax, which is tax on assets. Then the value-added tax, there are also exemptions in that setting. Then the stamp duties. The customs and excise duties, which is administered by the Customs Service, is also another form of tax that we collect in the country. So what are tax incentives? These are preferential and measurable tax treatments that are offered to a selected group of taxpayers, which exempt them from payment of all or any of the applicable taxes. It could be in form of the minimal tax rate. It could also be deferment of the tax payable now to a later period, and it could be an outright tax holiday for a specific period. According to Nubia, tax incentives is a deliberate reduction in or total elimination of tax liabilities granted by government in order to encourage a particular economic unit to act in some desirable ways. And they refer to special arrangements in form of policies and laws to attract, retain, increase investment in particular sectors, stimulate growth in special areas, and assist companies carrying on identified activities with underlying basis to ensuring the overall growth. So reasons for incentives. Why do we have incentives? Basically, there are three generics for having incentives. The first one is industrial. The second is to drive foreign or domestic investment in the economy. And the third is infrastructure development. Containing these three generics are benefits such as employment generation, export promotion, consumption pattern, import control, increase in the level of productivity, and development of new areas and frontiers. Now, policy consideration. Remember I said that every tax system is based on three pillars. Now, if you don't have policy considerations that drives your system, you may not be able to craft or draft your tax laws in such a way that you can derive the benefits from such incentives. So for tax incentives, in Nigeria, they are based on laws and policies. From the policy standpoint, tax incentives should be deployed as tool for economic growth and diversification. Tax incentives must not be granted arbitrarily. Instead, it should be targeted and sector-based. Then we must carry out cost-benefit analysis and economic impact analysis for us to be able to design the appropriate tax incentives that is required. Then the attendant benefits to the overall economy must outweigh the cost of the taxes forgone, and incentives are supposed to be periodical. It should be periodical. It should not be forever. It should not be to eternity. And incentives must be monitored to avoid abuses. Then the tax laws. So for us here, we have the company's income tax, and I said that there are so many allowances and incentives, exemptions under the company's income tax. Then for companies that operate within the free trade zone, if you operate within a free trade zone, then you are exempted from paying taxes as long as you're probably making productions for export outside the country, or the transactions are carried out within the free trade zone. But if you are dealing with the free trade zone and the customs area, that is outside the free trade zone, and you are selling your products there, then this have tax implication. For personal income tax, that's under the Personal Income Tax Act. You are all aware of your reliefs and allowances, and if even the minimum tax arrangement that, look, if your income is below a certain level, you don't pay any form of tax. And like Madam mentioned, where you have overpaid because you're supposed to file your returns, the tax authority can review your returns, and where you have overpaid, you can also get refunds. It's applicable here. The challenge is the fact that a lot of us just find it difficult to fill those forms that will state clearly what are the earned and unearned income. But what we do is we make our payee payment based on schedules, but the actual forms that are supposed to be filled by everybody within a specific period, the state internal revenue still have challenges with people submitting those forms. And if those forms are not on ground, it's difficult to actually do a proper assessment of what are the taxes and the benefits that you're supposed to derive. Industrial Development Income Tax Relief, that's the legislation that guides tax holidays. Under that, the DTRA, the first 3 years of, if you're operating within a particular sector, the first 3 years of your operation is exempted from taxes. Now, based on performance, you can get an additional 1 year, an additional second year, which makes it available for 5 years, depending on if you're doing what is expected. Then the form of incentives, in what forms do they come? I've said that, look, you can be an outright exemption from tax payments. It could be a deferment of the tax that is supposed to be paid. It could be a reduction in the rate of the tax that you are supposed to pay. It could be in form of allowances, capital allowances, personal allowances, and all those forms of allowances. There are also incentives, deductions from taxable profits. Export expansion grant is also another form of incentive. Then tax-free or tax holidays, accelerated capital allowances. Those are forms of incentives that are available for companies. Then free interest, tax-free interest, dividend, and royalties are also incentives. Then recovery of expenditure incurred on selected projects. Those are the incentives comes in that in those forms. And what are the available incentives in Nigeria? What are the available incentives that we have in the country? Seems repetitive, but the message is for us to be able to identify specifics. Now, tax holidays, they are for pioneer companies or companies in the mining sector. There is 100% exemption for companies within the export processing or oil and gas zone. Then investment tax credit in form of spare part fabrication, local manufacture plants, research and development, replacement of obsolete plants and machines. For companies that are located where there are no infrastructure, they enjoy investment tax credit. Related to the companies that are located where there are no infrastructure, there's also the rural investment allowance with a lot of modifications of late. Then the road infrastructure development and refurbishment investment tax credit, which was implemented in recent times, where companies will have to develop roads, refurbish roads, and get reliefs in form of tax credit to reduce the taxes that they pay. Then deductible capital and other investment allowances in various degrees, tax-free interest rate, tax-free dividend, gas utilization incentives, then the rates for small companies, for those who are below certain thresholds, 0, for those who are operating at 20%, and for those who are operating at 30%. There are other incentives under the Value-Added Tax Act. Then the tourism incentive, where 25% of income derived in convertible currencies and is warehoused in the reserve funds of that company, and when used within 5 years for investment in hotels and tourism. Now, I have a small table here to draw up the nexus between granting tax incentives and the revenue. There's a bit of a challenge in using the gross domestic product in Naira because of the fact that there's always this fluctuation, the instability, the macroeconomic indices that you use in economies, interest rate, exchange rate, and stuff. The rate of fluctuation in our exchange rate makes it very difficult to deal with GDP in Naira value. So that's why I have the GDP in the USD and the growth rate. But more importantly is the revenue angle and the tax incentives that have been granted in the country to be able to see how they relate. What we have there is not inclusive of the customs revenue. So the data I have is limited to the tax revenue from the FIRS and the incentives granted on the taxes administered by the FIRS. From 2015 to 2023, we can see the tax incentives that are granted in billions as against the revenue collected by the FIRS. There seems to be some degree of correlation there. The growth that we have in the revenue is also having such similar effect on the growth that we have in terms of incentives. So as revenue is growing, incentives are also on the increase, and which tells me that a system can have a mix of revenue generation as well as incentives combined to drive a system. For the customs also, from 2018 to 2023, there's also been increase in the custom duty waivers that have been granted to companies, just as their revenue is also increasing. The challenge that I have with this with the data is the fact that what you see in terms of revenue growth and incentives does not really translate to what you see in terms of the GDP that we have in the system. Meanwhile, we talk about tax revenue to GDP, but the growth that we have that is measurable in terms of the incentives and the revenue does not also translate to the GDP that we have in the country. Let's take a look at 2021. The country has $440.6 billion in terms of GDP in 2021, a growth from the previous year by 1.9%. Now, in 2022, the GDP increased to $472.6 billion and growth of about 7.3%. Though I have seen reports, those reports that put the growth rate at 2%, 2.3, 2.1 are the ones based on the Naira denomination. Now, if you now check with the exchange rate, because this is real, this is the real growth. If you check with the exchange rate, why there is Naira increase in the GDP in 2023, with the exchange rate as at that period, because this also contained in the CBN and the Bureau of Statistics data, the GDP reduced to 362, which is a reduction of about 23% in real terms. In nominal value, in Naira, it increases, but in real term, it is low. However, when you compare that with incentives, incentive keeps increasing. So there seems not to be real correlation between incentives and the GDP. Now, revenue laws and tax incentives in the country. So on the average, what we do in terms of tax incentives in Nigeria for the net of the customs is 555 billion annually. That is what it costs government in terms of incentives that are granted to companies. And like I said, that is net of the customs. What they grant in custom waivers on annual basis, on the average, is even more than this 400. That is in the neighborhood of 500 to 600. So what we have as total incentives for companies, when you put the FIRS and the customs and other areas together, is in the neighborhood of about 1.1 trillion every year in terms of incentives granted in the country. However, with all these incentives, reports have shown that if you set up a company, if we bring 10 companies out today, 10 companies, say we register companies and they start operations, reports have shown that 50% of those companies will go down in the first year, starting operations in this country. And subsequently, a year or two later, maybe about 20%. So you realize that in 5 years, most of the startups that we have, in 5 years, maybe just 20% of them are struggling to exist, which means there is an issue with the environment. There's something that is fundamentally not working for us in the system. And this is empirical, so you can also confirm that. And what we've been able to liken this to, the high cost of doing business is the first major factor for failure of businesses, followed by the level of technology development, shortage of requisite manpower, low level of infrastructure development, and security of lives and properties. Let me liken that to those who are doing agri business. A lot of people don't even go to the farm just because of their security, the security of their lives and property. Just for security reasons. A lot of farmers just stay back. You understand? And that is in the agri sector. For the other ones, that's where issue of manpower, infrastructure, and all those comes in. And from the case study I'll show you, we've realized that incentives, granting tax incentives, can actually help a lot of these companies to develop and develop very well. And that development will transcend into a global development in the country. Now, monitoring and evaluation, this has always been a major issue. Who's monitoring what? How are we able to monitor incentives in this country? It's been a big challenge. And if I ask this house now, who is responsible for monitoring incentives in the country? Which agency is responsible for monitoring and evaluating incentives in Nigeria? Is it the FIRS? Is it the Nigeria Investment Promotion Council? Is it the Ministry of Trade and Investment? There should be a clear understanding of which agency is actually monitoring this. That is when you can talk about the tax expenditure. This is what has been the cost of incentives to government. But if FIRS is doing its own, Customs its own, NIPC, Trade, and all others are working differently, and even the coalition, you understand, of the data will be a problem because there must be a source. Even if it is the Nigerian Bureau of Statistics that we have to send the details to, there must be that coordination between those agencies. So for FIRS, prior to 2021, all companies that obtain pioneer certificates, all companies, as long as you have a production date and you have a pioneer certificate, your businesses are handled in one place. That is, you have to go to the FCT. There's a tax office called the Medium Tax Office in Abuja. That is where you file all your returns. Even if you are in Kebbi, even if you are in Samfara, everybody must go and file their returns at the Medium Tax Office in Abuja. Before that arrangement also, we used to have what we call petroleum and pioneers, based in Lagos. So which means that all pioneer companies are domiciled in one place. But there was an audit, national audit that was carried out. And one of the outcomes from that arrangement was that we have to decentralize this domiciliation of pioneer companies, non-governmental organizations, non-for-profit organizations. They have to be decentralized. You also have to make life easier for them. You don't expect companies that are within the free trade zone in Lekki to go and be filing their returns in Abuja, even if it's online. There must be something that will have to take you to the tax office at one point or the other. So that report enabled the FIRS on its own to decentralize the location of pioneer companies and the non-governmental, non-for-profit and non-governmental organizations. And those operating the minerals and mines companies, they were decentralized such that you now have them at various locations. And further now, I've found out that they have not even been integrated into the tax offices, so you can work, you can do your business at the nearest tax office to you. Tools for analyzing tax incentives. There are about 3 basic tools for analyzing tax incentives. Whether we get it right or not is another issue. There's a marginal effective tax rate. This one is used to measure the effects of incentives on how they improve the returns on investment of companies enjoying such incentives. Then there is the tax expenditure budgeting, which is what we do in this part of the world. We look at what is supposed to be the revenue that will have been collected. Now that incentives has been given, we use that as the tax expenditure, as cost to the government. Then there is the specifying criteria for analyzing selective incentives, which is used on economies that set clear deliverables and use them as objectives and key resources, which is more like setting KPIs, key performance indicators. Now, you use that, those objectives and key resources that you put together will be the benchmark for you to now say that, okay, this is what we want to achieve, this is what we've been able to achieve. So it's just like setting KPIs for the companies, and they are being monitored. The Nigerian tax system has really not keyed into the use of these tools. However, with the various amendments through these finance acts that have been running for so many years, it is now mandatory for companies that operate within the free trade zones to file their returns. So it's also mandatory for companies, whether you are for profit or not for profit, to file. So every company is supposed to file returns. So if everybody is supposed to file their annual returns, then it's easier for us to do this, use that tax expenditure budgeting to find out. There will be another group that will be looking at the revenue laws. That is what's supposed to be and what it is. So that we'll be able to use that to monitor and analyze incentives. Challenges to monitoring and evaluation of incentives. So the first one I said is too many avenues for granting incentives and waivers. The president can wake up one day and say that CITN president don't pay tax. Ministries and agencies, there are so many of them. Trade and investment doing their own, finance, so many ministries and agencies, minerals, extractive industries, and everybody is granting incentives. We must be able to coordinate ourselves. Who is granting incentive for what? Where there are too many proliferations, that becomes a problem. Even the agencies, the FRS, the local government authority, the SIMA, the state revenue authorities, despite the fact that we have legislation granting these things, we're still not able to get those incentives right. Lack of proper coordination of available incentives and empirical data on existing incentives. Inability to determine the extent of revenue loss due to available incentives. Low level of exchange of information. A lot of organizations are not seeing themselves. They are not passing information around. The level of reliance on available data and the variety of data from so many questionable areas. The low level of synergy or cooperation between the FRS itself and the Nigeria Investment Promotion Council. For the purpose of this pioneer legislation, pioneer certificate, FRS and the Nigeria Investment Promotion Council must always be working together, because what do? Nigeria Investment Promotion Council wants to promote investment in the country, and they grant tax holidays. Who administers these taxes is the FRS. So they must have areas of collaboration. Is NIPC even on the board of the FRS? Is FRS even on the board of the NIPC? That's for you to find out. No basis to benchmark the attendant benefits of these incentives. Inadequate yardstick for measuring the level of productivity even within the economy. The challenge posed by the level of transparency and accountability on the part of the taxpayers and the authority, and the level of technical know-how. That's another very critical area that we need to address in terms of this incentive management. The technical know-how needs to really be addressed. How to address the challenges? Now, I said need to properly harmonize available incentives in the country, determine the relevance of the agencies involving in granting these incentives and create synergy. Is just going to be like the opposite of the issues that I've raised. Need to develop with an adoption of 15% effective. The fact that the agency that is granting has granted 5 years ago. The fact that even the product does not even qualify for it. And the fact that the company is eventually moving to a free trade zone where they will not even pay tax for operations if that's maybe it's an export processing zone, that if they sell their products within the free trade area or the export. But what do? They are even selling those items within the Nigerian customs territory. That's within the Nigerian system. Now, for companies who are competitors, if this is not properly monitored, they will have the advantage over companies that are operating normally within the country, they will have a comparative advantage. So companies like this, automatically when you see issues like this, that's a case for investigation. Now, this schematics is from the OECD countries, and it's about how they have used tax incentives. You understand this power thing that we're talking about. How they use tax incentives to benefit companies that are providing power generation. That's in terms of infrastructure. That's giving benefit to those companies and to the economy. Now, that's the mix of the regulation: tax policy, monetary policy, budget, and pricing. Those are the regulations that they put in place. But empirically, they found out that the most potent policy that has given effect to what has happened within the OECD country in terms of power conservation and leadership in terms of power generation are the fact that they enjoy tax credit, tax reduction, tax holidays, and accelerated depreciation. Those were the incentives given to whether you call them GEMCO, DISCO, or transmission companies. You were granted incentives like no man business because ultimately what will happen is that there's going to be economic benefit, there's going to be a more friendly ecological system, and there's going to be attendant social effect, which is developing. Monetary policy is also there, and the monetary policy works with their tax policy. They are not working in different directions. When the people who are talking monetary policy are those who are talking fiscal policies, they are always sitting in the same area to make sure that this thing works. Now, implementation, you can go this way to implement, go that way to implement, not systems where monetary policy is going in one direction, fiscal policy is going in another direction. You can use pricing policy. What do we have here? We're talking about band A and band B. They also use pricing policy. They use budgetary policy. But the most potent from this report is verifiable or is the use of tax policy to grant incentives to develop infrastructure. And what ultimately happened, if you look at the item number 3 there, it said why the benefits for business entities will include tax reduction, cost reduction, more environment friendly products to the states, to the company, to the state. There are environmental advantages, though delayed effect of the tax generation now, but incremental effect in the long run. So that brings me to the end of my presentation. Thank you very much.
Like we have heard today, tax incentives are supposed to be put in place to encourage investment in a particular sector, or to encourage investment in a particular area that we are focusing on. However, we have raised a lot of issues on: are we monitoring? Are we making sure it is not in perpetuity? However, I really love this last slide that talked about what it should really look like. So if we say we are putting tax incentive in place, just like what Mr. Olatunji shared with us, do we have other policies, pari passu, working together to ensure that those tax incentives are indeed incentives for the organizations that we want to encourage, or for the sector that we want to encourage? Do we have infrastructure in place? You know, so it was talking about the fact that people don't even go for pioneer status again, and I can attest to that. We've had to do, you know, opinion or advisory work for a lot of organizations who wanted to come into Nigeria and truly invest in our country. And we tell them that, oh, if you come to the agricultural sector, you have this investment, you have holiday here. If you produce this, if you are, for example, cotton, that if you are producing cotton, you are even going to have 100% tax-free. You are going to be tax-free for the first 5 years and all of that. But guess what? The next question is always, what about security? What about infrastructure? What about power? And most times, by the time they put all those other factors together, they do their cost-benefit analysis and they're like, is there really, are we really benefiting anything? So I guess the question should be, how exactly are we able to optimize tax incentive to help government indeed generate revenue if it is just a single policy or is standing alone? It cannot stand on its own. So meaning we need to build other structures to ensure that indeed tax incentive we have enabling environment. Yes, that's the word. We've had this beautiful presentation, sir, and my own question will be, if from data and from analysis we are seeing that GDP is not growing at the same rate, even though tax incentive, pari passu, tax revenue is improving, but it's still not answering the question of helping to generate more for the government, which in turn will help us to build our country and our infrastructure. What then how would you advise government? What should we do to ensure that whatever we are doing, our GDP is still increasing as we try to encourage investment into Nigeria? How can we still optimize our government revenue whilst we are putting in incentives in place? Or should we say these incentives are disincentives from what it looks like, looking at the whole picture and not just looking at it pari passu tax revenue?
It's the impact of tax incentive put in place against or vis-a-vis the tax yield to government. In other words, is it a counterproductive exercise, or do we have a way of measuring what we have achieved through this tax incentive in place?
My question is, I just want to ask, why is it this difficult to monitor tax incentive in Nigeria? Is it lack of technology or corruption or experts? Why is it difficult?
My question is, looking at all the incentives, they've always gone to corporate organizations. Are there no incentives for the ordinary common taxpayer, ordinary person? What are the incentives? Because it might go a long way also to check tax evasion and non-payment of taxes by citizens, as well as even paying grudgingly.
My question goes like this. In relation to tax incentives, I know it is being relieved by the taxpayer for government to generate more revenue. I think the tax practitioners, we that are consultants, we are also part of the system that helps government to generate more revenue. Is there any provision for tax incentive for us tax practitioners?
Sir, in the course of your presentation, you said that in 2023, International Monetary Fund recommended that incentives should be rationalized, or simply put, stopped, in order to boost revenue. Sir, I know you are an expert, and I want you to politely write to IMF to find out for them to also comment on the effective utilization or otherwise of revenue generated in Nigeria, with recommendations too. Number two, sir, please, I want to find out, you have talked about incentives. I want to find out whether incentives, is synonymous with tax exempts or consolidated relief allowances. I know somebody from the outflow has already said something on that, because I want to understand whether employees, that is personal income tax, whether we are also enjoying any form of incentives apart from companies.
The first question is this: considering the financing of a budget by our government, successive government, we have seen over the years that they've always been borrowing. And borrowing will always come with, loan borrowing will always come with terms and conditions, especially by international monetary organizations. So what, and we haven't seen the translation of these loans into infrastructural transformations, maybe like power, energy, industrialization, and so on. So what best advice can you give the government that aside loan borrowing, what other areas can they look into to finance budget? Secondly, are there law provisions? Because I believe many of us here maybe are in public sectors. Over the years, we've always been, working and receiving salaries and paying personal, what's it called, payee. But no one, I don't know, has enjoyed tax relief. And this is a form of tax incentives. So are there law provisions against the employer of labor that will compel them to pay tax relief to workers that might have worked over the years? And lastly, we always hear of multiple taxations. What best ways can you advise the government to synergize and maybe put this together in order to reduce this, since this is always discouraging businesses and is not allowing businesses to thrive?
Let me start with the question from the panel chair about GDP growth and how we can address this. When I was making my presentation, I said, look, the first thing we need to look at is the environment. There are macroeconomic indices that needs to be put in place to make incentives work. The first, let's talk about interest rate. Let's talk about exchange rate. Let's talk about the rate of inflation. And that's why you have to have policies, monetary and fiscal policies working together. The foundation has to be laid for you to have the desired result. And that is addressing the macroeconomic fundamentals in the system. Everything works together, they don't work in isolation. So if we're going to have that growth, we need to do something about this exchange rate. Last year, 2074, look at the benchmark to the US dollar. The budget that is being presented now is at 1,400, which means that government is not going to do business below 1,400 naira to the dollar. That has a lot of effects. The MPR from the ministry, from the CBN, is what's more or less determining what goes out as the lending rate for businesses. So we need to address the macroeconomic fundamentals. So if we continue to raise incentives and run after revenue, the environment must be available for us to derive growth and development. And in the presentation, I talked about having sustainable economy, sustainable environment, and sustainable socials. If they don't exist, we're just like running in circles. The question as to whether incentives are counterproductive, they are not. What we have not been able to effectively do is to monitor those incentives properly. And if you look at the recommendation, we say that let all the agencies work together. So, I'm struggling here to give you the data of incentives that's available. I had to talk customs separate, talk FRS separate. And in the course of my presentation, I went to the Bureau of Statistics, I went to CBN, I was looking everywhere, whether I could get these things. So I have to cherry pick, go to finance, go to this, go to that. So we need to be able to consolidate. We're a nation. Everybody should work together, agencies should work together. You understand? So we can see the effect of what we're doing. So I see no reason why agencies cannot work together. They should be able to work together. We shouldn't work at cross purpose. And I'm not sorry to say that in terms of our monetary and fiscal policies, yes, can we say that they are working together? Can we really say that the monetary policies and the fiscal policies that we are doing, they are working together? Thank God for the fiscal committee of the president. But for a system to work, monetary and fiscal policies must work together. They must not be at cross purpose. On the issue of individuals, if I have to address the release under the personal income tax, that's a whole topic for itself. I mean, what you pay is either payee or, for my friends who is in practice, sustainable. For us, though, revenue is the most sustainable form of funding for government. Taxes. And when you talk revenue, you are talking taxes. The National Tax Policy document, the first National Tax Policy document, talks about revenue, and the basis being, the first is taxation. Every money that comes into government is revenue. Sales of crude is revenue. Sales of government assets is revenue. Investment by government is revenue. Borrowing supports revenue, but the most sustainable form of revenue for us in this part of the world is taxation. So we need to get tax right. We really need to get it right, either at the local, state, or the national level, because that's the most sustainable. Today, we're looking towards moving to over 2 million barrels per day. The fiscal arrangement for last year was 1.67, but on the average, we are doing 1.4 because of issues that we have where the sales of crude oil is coming. And the world is even moving away from crude. We are moving away from oil, from fuel. So, even if that is our focus, for how long? So we need to get our act together so that we can really do tax, and do tax the way it should be done, but putting it on the right platform, the right foundation. Whether we can compare companies to give relief to individuals. That's our social contract in terms of tax is different. What you can do is the social contract between you and the government. The government has a right to provide an enabling environment for you, and you also have to declare your income and pay the taxes due. The arrangement between you and your organization is you. You need to be able to lobby and get whatever you want to get from your organization, but the reliefs are there in the personal income tax. I remember at the point when government was even saying that when they brought this arrangement in companies, that if you employ a certain number of people, you understand, you get, those are advantages, but between you and the organization is between you and the organization. Government cannot come in and run the organization for it. On the issue of multiplicity of taxes, I have to say that I give kudos to this federal government fiscal team. If only we can take the goods. There are goods in things they are doing. When I was making my presentation on taxes, I did not talk about special purpose taxes, and it was deliberate. I didn't put education tax, I didn't put technology tax, I didn't put NASENI, I didn't put all that, because they are supposed to, they are special purpose taxes. But if we get it the way it should, we shouldn't be running special purpose taxes. Why do I have to pay education tax when I'm paying my tax? Why do I have to pay technology levy when I'm paying my tax? Why do I have to pay police funds when I'm paying my taxes? Those are special purpose taxes. And if we allow it to go that way, everybody will come up and say, apart from companies' income tax pay. And that's what this policy committee is addressing, to say, all those special purpose taxes, we will arrange in such a way that the base will not be overburdened, because it's still the same base. Whether it's accessible profit, whether it is taxable profit, whether it is total profit, it's still the profit of the organization. So, if it's not what I can address here on multiplicity of taxes, but a committee is looking holistically into it, and I'm sure if they will take the positives from the work of that committee, the issue of multiplicity of taxes will be a thing of the past. Thank you.
Thank you. Thank you very much, sir. I think you have covered everything. Let me just add one or two things to what Mr. Olatunji has said, especially because I see that from our questions, we are all personally interested in what comes to our own pocket in terms of personal reliefs. Sorry to say, there is no special taxes, tax incentive for tax practitioners. We are taxed as though you are earning income like any other person. We all need to take time to study the new tax bills. and we will see a lot there. So for example, even for personal income tax, although the rates have been graduated, but we will see that for most of us, we may not pay as much taxes again. Most of us will fall in the bracket of, you know, not as high as before. But those of us who are high net worth individuals, you are going to pay the taxes for those of us who are not earning so much. So I'm looking forward to that. Let the people who are earning so much, with people who have all the big houses in Banana Island, let them pay the taxes, and those of us who are earning small money, let us have some relief. So we will see that the band is now starting from 800,000, and even 800,000 will be 0%. So that's already a great incentive for us. So let's all just put our ears to the ground. There are a number of incentives there. Even for companies, the taxes are being consolidated. Even for the VAT, we are now going to be able to claim all our input VAT. Because I'm always of the opposing view when they say our VAT rate is really small. I will say, but we are not able to claim all our input VAT. However, that has been taken into consideration in this new bill. So those are the conversations we should be having now, so that we'll be well equipped to encourage our people, to consult properly. There are bigger punishments for us as tax consultants if we don't give our clients proper advice now. So please let us be informed that we need to be more responsible. So as I round up, I think what I would like to say is that from this conversation, we've seen that tax incentives are good. They're a good way by which we can encourage investment into our country and generate more revenue. However, they cannot be in perpetuity. They cannot stand alone. They need to be monitored for effectiveness. They need to be reviewed over time. And I think, if I may dare to say, sir, accountability is also key. All the monies, all the revenues that we have generated from companies who have come into the free trade zone, can we now start asking governments that what have they used the revenue to do? And can we also block other leakages that we see around? I'm hoping that this tax bill, like you said, if we can take the positives out of it, it will really help us as a nation. We may have some teething problems, but in the long run, will be better for it. If we go to other countries and we say they are doing well, they had to do what they had to do. So that's why their people are no longer, so paying to pay 40% taxes, because they know when they get home, there is light. They are not, the infrastructure is there, but it doesn't mean that they are also not paying taxes. So let's encourage ourselves. Let's not think everything is a disincentive. We have some good incentives, but they must be monitored. They must be evaluated periodically. They shouldn't be in perpetuity, and data will help us. So with technology, and as we continue to, join the global best practice around the world, I believe Nigeria will be better for it.